In Chapter 5, we're going to talk about interest rate derivatives. And while interest rate derivatives are the largest derivatives market, it is unfortunately also the case that finding the fair price of interest rate derivatives is much more difficult than finding the fair price of other derivatives. Interest rate derivatives started trading in the early 1970s, and then these markets started to grow very fast. This picture we have already seen in the introduction chapter, and it illustrates that if we measure by the notional amount, interest rate derivative markets are by far the largest. Secondly, if we measure according to market value, we see a very similar picture. The biggest market value of derivative markets are derivatives linked to interest rates. Unfortunately, interest rate derivatives have a lot of conventions and terminology, and we will go through this first. The first thing is day count conventions, and day count conventions are all about trying to figure out how much interest you earn between the last coupon payment a bond has paid and the date where you are right now. And instead of just counting the actual days between two coupon payments, and the actual days between the last coupon payment and where you are right now, people come up with various different types of conventions and simplifications. So there's the actual accrual, and that would actually count the actual number of days. And these accruals on actual basis are used, for example, for US Treasuries. Then another convention is that instead of counting the actual number of days between coupon payments, we just simplify and assume that the year only has 360 days or 365 days. And therefore, if we count the number of months between coupon payment, we would just take a proportion of these either 360 or 365 days. And we come to an example on the next slide. This type of day count convention is popular for money market instruments, and in particular in currencies like, for example, the US dollar, we often use the reference of 360 days assumed per year, while, for example, in British pounds and Hong Kong dollar, as well as Australian dollar and New Zealand dollar, you would assume that they are 365 days per year. And then we have the day count convention where you assume that 1 month has exactly 30 days when you count the days between the last coupon payment and today, or in other words, 360 days per year. And when you calculate the number of days in the reference period, so that's between two coupon payments, then you assume either 360 days per year or 365 days per year. And this kind of convention is quite often used for corporate bonds. So let's go to some example to illustrate that. Let's suppose that you have a 5% coupon bond, and payments are made once every 6 months on March 1st and September 1st. And let's assume that the face value of the bond is $1,000. This means that 5% of $1,000, that's $50 coupon payment per year, or every 6 months you get half of that. That means coupon payments every 6 months are $25. The question which we want to ask is, how much interest do you actually earn between the last interest payment on March 1st if you are today on June 5th? And this now will depend on how we count these number of days between March 1st and June 5th, and also how we count the days between March 1st and September 1st, which is the reference period. If you have the actual day count convention, then you would actually count how many days are there between March 1st and September 1st. And if you count that on a calendar, you will find these are 184 days. So that would be in your denominator. And then you count how many actual days do you have between March 1st and June 5th. And if you do that, you count 96 days. And that means now the interest which you earn between March 1st and June 5th is going to be the 96 days which you have waited since the last coupon payment divided by the 184 days which you have to wait from March 1st until September 1st until the next coupon is paid, times how many dollars you actually get at the next coupon date. And in this case, that would give you $13.04. Now, what if the day count convention is actual versus 360 days per year? So here we now make the simplifying assumption that every month has 30 days, or in other words, between March 1st and September 1st, because these are 6 months, we assume that you have exactly 180 days. For the numerator, we still count the actual days between March 1st and June 5th, and that's again 96 days. And therefore, the interest earned now is 96 divided by 180, and then multiplied by $25, which you get at the next coupon date, and that would now be $13.33. And the last convention is the one where you assume there's 30 days per month, both when you count the interest between last coupon date and where you are right now, and also for the day count between the two coupon payments. So that means, again, between March 1st and September 1st, there are 6 months. So you just, for simplicity, assume that there are 180 days. And now between March 1st and June 5th, you count that there are 3 months from March 1st to June 1st, and then from June 1st to June 5th, there are another 4 days. So you would say 3 months times 30 days is 90, plus the last 4 days, that will give you 94 days. So therefore, you have now 94 divided by 180. That's the percentage of days you have waited between March 1st and June 5th under the simplifying assumption. And you multiply that again by the $25 which you earn between March 1st and September 1st. So in this case, you would get accrued interest of $13.06. Notice that depending on the assumption of what kind of day count convention you take, there are slightly different amounts of accrued interest, which you assume that you earn between March 1st and June 5th. But the largest difference you could ever get, depending on these different day count conventions, is if you consider the difference between February 28th and March 1st. Why is that? Well, it's because the month of February ends on the 28th day. And therefore now, if you use the actual day count convention, then you would say, well, between February 28th and March 1st, there is actually only 1 day. But if you assume that each month has 30 days, then you would count, well, February 28, February 29, February 30, March 1st. So you would actually count 3 days of interest which you earn between February 28 and March 1st. The next convention is about how to quote Treasury bond prices. And for Treasury bond prices, we have something called the quoted price, or also sometimes known as the clean price. And then we have the cash price, or also known as the dirty price. The quoted price is always given in dollars and 30 seconds of a dollar. So for example, if you would see 90-05, that means the dollar amount of that quoted price is $90 plus 5 divided by 32, which gives you a quoted price really of $90.15625. Now, the quoted price is always given per $100 face value. So if you would actually trade a bond which has a face value of $1,000 and the quoted price is 90-05, then the actual quoted price which you have to think about is this $90.15625 multiplied by 10. To make things a little bit more complicated, you're not actually paying the quoted price when you buy a treasury bond, but you pay the cash price, which is the quoted price plus the accrued interest. Where again, the accrued interest, as explained on the previous slides, is the amount of the coupon which you earn from the last coupon payment date until to the date where you are right now when you trade that treasury. And remember, for US Treasuries, the day count convention is actual. That means you count the actual number of days between the last coupon date and today, divided by the actual number of days between the last coupon date and the next coupon date. Let's look at an example of a 15% Treasury bond, where coupon payments are made on January 10th and July 10th. And let's suppose that the face value is $100. 15% coupon bond means that you get 15% of the $100, which is $15 per year. And since coupon payments are made twice a year, that means you get half of the $15, which is $7.5 each on January 10th and July 10th. Now let's suppose on October 19th, you see the quoted price of 89-24. Now what would be the actual price at which you can trade that bond? So if we count the number of actual days between July 10th and October 19th, then these are 101 days. And if we count the actual number of days between July 10th and January 10th, then we see that these are 184 days. So for accrued interest, we take the 101 days, which I have already waited for the next coupon, divided by 184 days, which I have to wait until I get the next coupon payment, times the coupon payment of $7.5, and that gives me how much interest I have already earned between July 10th and October 19th. Now, to figure out the cash price, so that actual price at which the bond is trading, we take the quoted price of $89 plus 24 divided by $32, so which is this $89.75, plus the accrued interest of $4.12, and that gives me now the actual price at which I trade the bond of $93.87 on October 19. Treasury bond futures are futures contracts written on Treasury bonds, and they're actually one of the most popular long-term interest rate futures contracts which we have traded. Notice that not for every Treasury bond which is out there in the market, we have a separate Treasury bond futures. This would be very impractical because there are so many different Treasury bonds out there. If you had a futures contract for each individual bond, then there would be too many futures contracts, and therefore trading volume and open interest in each of these futures contracts might be very low. So what people are doing is they only trade one Treasury bond futures, and that futures relates basically to all the Treasury bonds which are out there. In particular, at the maturity date of the Treasury bond futures contract, the short position in the futures can choose which Treasury bond she wants to deliver. The only requirements which have to be satisfied is that at the delivery date, the Treasury bond which will be delivered has at least 15 or more years left to maturity. In addition to decide which Treasury bond the short position wants to deliver, the short position can further decide on which specific day during the delivery month she wants to deliver that Treasury bond. Prices for Treasury bond futures are quoted in the same way as Treasury bonds, meaning in dollars and 30 seconds. One futures contract is always written on the delivery of a face value of $100,000 of Treasury bonds. But again, the quoted price always refers to a face value of $100. The cash price of the Treasury bond futures per $100 face value of the delivered bond is calculated as the most recent settlement price in the futures contract multiplied by something known as the conversion factor, and I'm going to talk more about that in the next few slides, plus again that accrued interest which the Treasury bond has earned since the last coupon payment. The purpose of the conversion factor is to make the different potential Treasury bonds which a short position can deliver more comparable. Notice if there was no conversion factor over here, then the short position would be promised to just receive the settlement price in the futures contract plus accrued interest, and then the short position would always just want to deliver a Treasury bond with the longest possible time to maturity and the lowest possible coupon rate, because that Treasury bond is going to have the lowest cash value today. And so therefore it's the cheapest bond which that short position could deliver to the long position. But if we had this case, then basically Treasury bond futures contract could be assumed to be just written on this one particular type of bonds which have a very low coupon rate and very long time to maturity. To make the different bonds more comparable, we introduced this conversion factor, where the conversion factor is going to be larger for bonds which have a relatively higher price, so the bonds with higher coupon payments and maybe not so many years left to maturity, and the lower conversion factor for bonds which have relatively low cash prices. If we do that, if you have these different conversion factors, now the short position may consider to deliver various different types of Treasury bonds, and therefore now the Treasury bond futures contract is more a futures written on a bigger set of Treasury bonds rather than just on one Treasury bond. The conversion factor of a bond is equal to the hypothetical quoted price of a bond per $1 of face value, assuming that the yield of that bond is 6% semi-annually compounded, and using maturity and coupon payments of this hypothetical bond equal to the actual bond which you will deliver in the futures contract, except that you will round down the maturity date to the closest 3 months. So to make this more clear, we're going to look next at an example. Let's suppose we want to find the conversion factor of an 11% coupon bond with 18 years and 4 months left to maturity. Now, the first thing we said, to find the conversion factor or that value of this hypothetical bond, we would round down the 18 years and 4 months to the closest 3 months. So what we assume is that instead of taking the actual time left to maturity, we assume that there are exactly 18 years and 3 months left to maturity. Now, the conversion factor is the quoted price of a hypothetical bond which has a face value of $1, and therefore the 11% coupon, 11% of $1 is 11 cents, and since coupons are paid every 6 months, I divide that by 2, or meaning 5.5 cents are paid as coupons every 6 months. So to get the cash price of that hypothetical bond, I take my face value discounted by 6% bond yield, semi-annual compounding, and then the time left to maturity until you get this face value of $1 is 18 years and 3 months. Now for all the coupon payments of these 5.5 cents, I have to add up the present value of always these 5.5 cents discounted back to today. The first 5.5 cents I receive after 3 months, so I have 5.5 cents divided by 1 plus, again, this yield of 6% divided by 2 to the power of 2, and I just multiply the 2 by 3 months. Now for the second coupon, which I receive after 9 months, I have again the 5.5 cents divided by 1 plus the 6% yield divided by 2 to the power of 2 times now 9 months. And so if you plug in now I equals to 1, that gives you 0.5 plus 0.25, which is exactly 9 divided by 12, or that 9 months which you have to wait. And so you can take this sum for all different values of I ranging from 0 to 36. That will now add up always the present value of these 5.5 cents, which you get paid every 6 months until to 18 years and 3 months in the future. So this entire thing is then the cash price or the actual value of that hypothetical bond. And now to get the quoted price, I have to subtract from that the accrued interest. And remember, for a treasury, I use the actual day count convention. And since we assume that there are 18 years and 3 months left to maturity, that must mean exactly 3 months ago I received my last interest payment. So the quoted price is then my cash price minus this accrued interest, and that's $1.54.98. Given this conversion factor, if the short position of a treasury bond futures were to deliver that treasury bond, then this short position would receive the most recent settlement price in the futures contract. So that's the last traded futures price on the maturity date, multiplied by now this conversion factor of that bond which the short position delivers. That's at 1.5498. And then plus accrued interest of the bond which that short position delivers. Notice that what the short position receives in the futures contract is this price, but the short position has to deliver a treasury bond, and therefore you can subtract the quoted price plus accrued interest of the bond which the short position will deliver. And the short position really wants to maximize this overall payoff. And you notice here that the accrued interest exactly cancels out in the value of the bond which he delivers, as well as the cash amount which he receives through the futures contract. We can further rewrite that by saying, instead of maximizing this term, I want to maximize the future settlement price minus the quoted price of the bond which the short position decides to deliver, divided by the conversion factor. And that's what I write over here on slide 13. So in other words, because the treasury bond futures price is not under the control of the short position, so she will decide to deliver a treasury bond which minimizes this ratio between quoted bond price and conversion factor. Notice that for the conversion factor, we assume this artificial bond yield of 6% semi-annual compounding. And therefore, if you think about more recent times where interest rates are relatively low, if the bond yield is less than that hypothetical 6% yield which is used for the conversion factor, then that means the conversion factor has more discounting than the actual bond which you will deliver. And that will actually make this ratio relatively large. And therefore, a bond with a long duration is actually considered relatively expensive. So during recent times, a short position in the Treasury bond futures contract would rather want to deliver something with a shorter duration. So a bond with a higher coupon payment and a shorter maturity, since that will help us to keep that ratio relatively small. In contrast, if bond yields were very large, if they were much higher than 6%, then the actual bond which you deliver is actually discounted by a higher rate than the conversion factor. And then you actually would like to do that discounting over a very long time horizon and with very low coupon payments, and you would want to maximize the duration of the bond which you want to deliver, such that this ratio becomes relatively small. So the short position, depending on what the current yields are in the market, will then decide whether it wants to deliver a shorter duration bond, so when yields are very small, or a longer duration bond when yields are very high. But this means that the payoff of these Treasury bond futures will not only depend on bond price changes due to interest rate changes, but actually changes in interest rates may also have an effect on which bond the short position will deliver, and therefore it will affect the payoff of these Treasury bond futures. So there are these two effects. One is the direct effect, where the interest rate affects the Treasury bond prices and therefore the payoff of the futures contract. And then the more indirect effect, where the changes in interest rates affect the choice of which bond will be delivered, and therefore that affects the payoffs of the Treasury bond futures. When we want to figure out what is the cash Treasury bond futures price, then we can go back in our lecture notes and look at that formula of a forward or futures contract written on an underlying asset which pays discrete payments, where these discrete payments are now just these coupons of the Treasury bond. And remember, our formula for the futures price, it is equal to the price of the underlying asset today minus the present value of all these intermediate payments. So here will be the present value of all these coupon payments until to maturity. And then this entire thing multiplied by what the risk-free asset earns until to the maturity date. Now notice that here are a few assumptions. This formula only holds if the interest rate is either constant or changes in interest rate are unrelated to changes in the futures price. But notice that changes in interest rates will actually affect the Treasury bond prices, and therefore S will drop as interest rates increase. And again, this will then translate in changes in futures prices, and this correlation will never be zero. Therefore, this formula doesn't quite hold because we have this correlation between changes in futures prices and interest rates. Secondly, this formula assumes that we know exactly which underlying Treasury bond will be delivered at the maturity date. But as we said before, as interest rates change, it might be that the short position will actually change which Treasury bond it wants to deliver. And then finally, the short position in a Treasury bond futures contract can choose to deliver the underlying asset at any day during the delivery month. And therefore, this will give us, again, a little bit more ambiguity. And this formula cannot be used readily because here we assume we know exactly on which day the underlying will be delivered. For all these reasons, the short position has somewhat of an advantage compared to a standard futures contract. And therefore, it has to be that the futures price in this Treasury bond futures contract has to be somewhat less than that futures price derived from that earlier formula. What's the intuition of this being less? Well, if at maturity the futures price still has to converge to the price of that underlying bond which will be delivered, then if the futures price is now less than this formula, it means that on average, in the Treasury bond futures, the short position actually loses out a little bit compared to what you have if the futures was equal to that formula. And that average loss in the short futures position will offset exactly the value which the short position gets from all these different features. Let's look at one last example where we stitch all of this together. Let's suppose that we know already that the short position in the Treasury futures contract will deliver a 9% semi-annual coupon bond with 20 years and 122 days left to maturity and a face value of $100,000. And let's suppose for simplicity that the term structure is flat and all interest rates in the markets are equal to 10% continuous compounding. So let's draw a timeline. In this timeline, we are here right now at current time. Now that bond which will be delivered in that Treasury bond futures contract, that had its last coupon payment exactly 60 days ago, and the next coupon payment will be made after another 122 days. In addition, we specified that the futures maturity and the delivery date of the Treasury bond is exactly in 270 days. So that means from the current date, 270 days in the future, that's the maturity date. Notice this means that from the next coupon payments, there are another 148 days until to the maturity date of the contract, and then there are another 35 days until to the next coupon payment after the maturity date of the Treasury bond futures. The first thing which we want to do is figure out what is the cash price of this bond which the short position will deliver at the current time where we are right now. I will do this in two steps. First, I will determine what is the cash value of the bond at that next coupon date. So that's when the bond has exactly 20 years left to maturity. And that's what I write in parentheses over here. And then I will discount that value by another 122 days at the 10% interest to figure out what is the cash price at the current time. So that's this discounting by 10% interest for 122 days. So let's now look at that bond value at that next coupon date where I have exactly 20 years left to maturity. So first of all, we have the face value of $100,000, which we receive in exactly 20 years. So that's discounted by the 10% interest rate for 20 years. And then we have 9% semi-annual coupon payments. That means 9% out of 100,000 is $9,000. Now coupons are paid every 6 months. So half of this $9,000 is $4,500 coupon payments. Now, when we are exactly at the coupon date, we receive one coupon right now. So I don't need to discount that anymore. So that will be in my sum, that first $4,500 where I is equal to 0. So I have this e to the power of minus 10% times 0 divided by 2. So this one is just 0 in the exponent. That means this e to the power of minus 10% times 0. This is just equal to 1. Okay, so the first term in this summation is just $4,500. The next $4,500 I receive after 6 months. So that I have to discount by 10% for 6 months. So that's what I do over here. If I is equal to 1, then I have e to the power of 10% discounting times half a year of this $4,500. Then the next coupon payment of again $4,500 is paid after 1 year. So then I would be equal to 2, where we have discounting by 10% for 2 times 6 months. So 2 divided by 2 is 1 year. And then the next payment will be after 1.5 years. So then I equals to 3 gives you discounting for 1.5 years. And you keep going all the way to the last coupon, which you get after 20 years, which is 40 divided by 2. Notice that this entire summation can be very nicely rewritten by this term over here. So we have this sum from I equals to 0 up to 40 of e to the power of minus this 10% interest times I number of half-year steps times that payoff of $4,500. So let's rewrite this as $4,500 multiplied by 1, so that's when I is equal to 0, plus e to the power of minus 10% times 1 over 2. So that's when I is equal to 1, plus e to the power of minus 10% times 2 divided by 2. That's when I is equal to 2. And keep going like this until e to the power of minus 10% times 40 divided by 2. That's when I is equal to 40. Now let's multiply this entire thing by e to the power of minus 10% times 1 over 2. And then we subtract the second line from the first line. And what we get is this summation from I equals to 0 to 40 of e to the power of minus 10% times I divided by 2 times this $4,500. That's what we are looking for, multiplied by 1 minus e to the power of 10% times 1/2, where the 1 over here represents that first term, and minus e to the power of minus 10% times 1/2 is the term over here. And similarly, on the right-hand side, we have $4,500. And now when we look at the terms inside bracket, we notice that the first term over here cancels out with the second term over here, the second term over here with the third term over here, the third term over here with the fourth term, the second to last term with the last term over here. And therefore, in parentheses, we are just left with 1 minus e to the power of minus 10% times 41 over 2. So therefore, this entire sum which we are looking for is equal to this right-hand side divided by this term in parentheses. And this is the annuity formula which you have seen in an earlier course. This is not particularly important for our course here. We just occasionally make use of it. But actually, when you go to like problem sets or case studies, then you can also just use Excel. In Excel, you can actually very efficiently compute this sum directly. So this is the same formula as I have over here, except that I already write the 10% divided by 2 as the 5% over here. So now this thing in parentheses, that gives us the cash value of the bond at that date just before the next coupon is paid, and discounting by another 10% for 122 days. That's now that cash value of the bond which will be delivered in the futures contract back at current time. The next thing which we want to do is figure out what is the quoted price of that bond which will be delivered. So we have the cash price, and we said that the quoted price is always per $100 of face value, while our bond has a face value of $100,000. So that means we have to first divide that cash price by 1,000. And then we want to subtract the accrued interest from that cash price. And notice that we have accrued interest for 60 days out of 182 days. So we take 60 divided by 182 times $4.5 coupon payment, which you get out of a face value of $100. And so therefore the quoted price is $89.35. Or writing it in dollars and 30 seconds, it's 89-11. Next, if you want to use our formula to figure out what is the cash futures price, under the assumption that interest rate is constant and none of these four features over here actually matter, then using our formula, we have the cash price of the bond which will be delivered is $90,840. Minus the present value of dividends until to the maturity of the futures, which is this one coupon payment, which will be made after 122 days. So I take these $4,500 discounted by 10% for 122 days. That's this $4,350. And then this entire amount of money, I multiply that by what the risk-free asset earns until to the maturity date. Again, we have 270 days until to the maturity. So we have 10% risk-free rate times the 270 days. That gives us a cash futures price of $93,120. Once we have the cash futures price, we would like to figure out what is the quoted futures price. And for that, we first have to figure out what is the conversion factor of the bond. because remember the cash futures price is equal to the quoted futures price times the conversion factor plus accrued interest. And for the conversion factor, we want to calculate the value of a hypothetical bond with $1 face value, and again 9% coupon payment, which is now 4.5 cents per 6 months. And notice the conversion factor is calculated as the quoted price at the maturity date of the futures contract. So here our bond has 20 years plus 122 days minus 270 days left to maturity. And rounding that down to the next 3 months, that would give us 19.5 years to maturity. So therefore, we have that $1 face value discounted by 19.5 years. And the discounting is for the conversion factor with this artificial yield of 6% semi-annual compounding. So the discounting is done by dividing by 1 plus the 6% divided by 2 to the power of 2 times the number of years left to maturity. And similar, we have to discount all these coupon payments, which we get every half a year. And again, they're all discounted at that 6% semi-annually compounded yield. And so here we have the sum going from the first coupon, which I receive in exactly half a year, until to the last coupon, which I get after 39 divided by 2, which is this 19.5 years left. So let's do this one more time. We want to compute this sum over all these coupon payments, starting in half a year until to 19.5 years. So we can also write this as the coupon which we receive multiplied by 1 divided by 1.03 plus 1 divided by 1.03 to the power of 2 plus 1 divided by 1.03 to the power of 3, and so forth, until to 1 divided by 1.03 to the power of 39. And if we multiply this entire thing now by 1 divided by 1.03, and we subtract the second line from the first line, then we get the sum which we are looking for, multiplied by 1 minus 1 over 1.03. And on the right-hand side, we have 4.5 cents multiplied by 1 divided by 1.03 minus 1 divided by 1.03 to the power of 40. Why is that? Well, because again, the first term down here cancels out with the second term up here. The second term cancels out with the third with the fourth, the second to last with the last term over here. Therefore, the sum which we are looking for is given by this thing, where we can also rewrite it in the following way. And this is exactly equal to what I write over here in the slide. So if you do that, then that cash value of that hypothetical bond with $1 face value and 19.5 years left to maturity is $1.342. And notice that there's no accrued interest because we have exactly 19.5 years left to maturity. That must mean the last coupon payment was exactly now. And this gives us our conversion factor for the bond. Finally, we know that the cash futures price is equal to the quoted futures price times the conversion factor plus accrued interest. And so solving for the quoted futures price, then we're going to have cash futures price minus accrued interest divided by the conversion factor. And that's what I write over here. So we have cash futures price minus accrued interest. Notice this comes from the fact that at the maturity date, the last coupon payment was 148 days ago, divided by 148 plus 35 days you have to wait for the coupon payment. That's this accrued interest over here. And divide this entire thing by the conversion factor. That gives you the quoted futures price. And again, the quoted price is always per $100 of face value. So divide that by 1,000. That gives you $66. And then the 68 cents, that's again written as 22 divided by 32. finally, notice that this is the quoted futures price again under all these assumptions that we actually know exactly at what day the short position delivers the underlying bond, although in reality the short position can deliver on any day during the delivery month. Moreover, we assume that we know at the current time already which one is the cheapest to deliver bond. So that's that bond which the short position will deliver. In reality, a lot can happen to interest rates until to the maturity, and the short position may change his mind and deliver a different treasury bond. And then it also assumes that the interest rate is constant or at least uncorrelated to the price of the underlying asset, which is definitely not true for treasury bond futures, because treasury bond prices will drop if interest rates increase. So in reality, actually have a negative correlation, and that also then gives you a negative correlation between treasury bond futures and interest rates. And then finally, again, in reality, treasury bond and treasury bond futures markets, they don't have the same opening hours, and in particular, treasury bonds are traded a little bit longer than treasury futures. So for the short position, who actually can observe at the maturity date the last settlement price in the futures, but then still has time to buy the treasury bond later and wait until maybe the price changes more favorably, that's an advantage for that short position. And for all these reasons, in reality, the quoted treasury bond futures price should be somewhat less than the 66-22. Next, I want to talk about Euro-dollar futures. And Euro-dollars are deposits in a bank outside of the US, so meaning deposits in US dollars, but in a bank which is not located in the US itself. The reason why it's called Euro-dollar is because the practice started by depositing dollars in banks in Europe. Nowadays, however, we have a lot of dollar-denominated deposits, and they could be in many different countries outside of Europe, and they're still called Euro-dollars. These deposits of the Euro-dollars can be made by foreign or domestic corporations, individuals, banks, or government institutions. Euro-dollar deposits range in maturity from overnight to many years. However, most of them are for the short term, so meaning less than 1 year. Euro-dollar futures are very popular and very actively traded futures, so similar to treasury bond futures. And Euro-dollar futures are written on 3-month Euro-dollar deposit rates. And you can think of the 3-month Euro-dollar deposit rate similar as, for example, the 3-month LIBOR rate. Euro-dollar futures contracts can have a maturity up to 10 years. And Euro-dollar futures contracts are settled in cash. The principal in a Euro-dollar futures contract is $1 million, and that means a change by 1 basis point in the Euro-dollar futures quote corresponds to 1 basis point divided by 4, because the quoted rate is annualized, but it's written on a 3-month interest rate, and then multiplied by $1 million principal, which yields then $25. For the final settlement, at the maturity, the quoted Euro-dollar futures price will be set to 100 minus the percentage point on the 3-month Euro-dollar interest rate. And the idea of having a negative relationship to the interest rate is that as a long position where you get money, if the futures quote increases, you want to receive money when the interest rate decreases, which in other words would also imply that bond prices increase. So the long position in the futures want to have the same exposure as someone who buys bonds. Notice that the way the exchange defines one contract is $10,000 times 100 minus 0.25, which accounts for that 3-month maturity of the Euro-dollar on which the futures is written, times 100 minus the futures quote. So this, in other words, is $750,000 plus $2,500 times the futures quote. So again, this refers to 1 basis point increase in the futures quote, where again the quote is in percentage points, so 1 basis point would be 0.01 increase in Q. That would correspond to $25 payoff. At settlement, as mentioned before, the futures quote will be set equal to 100 minus the 3-month euro-dollar interest rate in percentage point. And therefore, if you plug that in over here, or in this formula over here, then you get $1 million minus $2,500 times the 3-month euro-dollar interest rate. Again, the negative sign says if the interest rate is decreasing or the euro-dollar quote increases, then the long position gets a positive payoff and exactly equal to $25 per 1 basis point increase in the futures quote. And this corresponds to also increases in bond prices as interest rates decrease. Let's look at an example where you start on November 1st, and let's say you have $1 million which you can invest on December 21st, and you want to invest that for 3 months. Now, on November 1st, you don't know what the 3-month interest rate is going to be from December 21st until March 21st. And so therefore, you would like to hedge that risk in the interest rate by entering euro-dollar futures contracts. Now, in particular, you want to take one long position in the euro-dollar futures contract because the long position will basically lock in the price which you pay for a bond on December 21st. Or in other words, if interest rates decrease and you're going to earn less interest on that $1 million, then the euro-dollar futures is going to give you a positive payoff and protects you against these decreases in the interest rate. So let's suppose on November 1st, the 3-month euro-dollar rate is 2.5%. And let's suppose that the futures quoted rate is exactly equal to 100 minus this 2.5%. Notice that the exchange only guarantees that at the maturity date, but for this example over here, we want to just assume that the euro-dollar futures quote is exactly equal to 100 minus this interest rate in percentage point. So that means the quote is 100 minus 2.5, which is 97.5. Now let's suppose over the next day, the 3-month euro-dollar rate increases by 8 basis points. Now multiplying that by $25, that means that the long position loses $200 on that particular day. Now, as it is common for all the futures, this means that the exchange will deduct from the margin account of that long position in the futures account $200 and deposit these $200 on a margin account of a short position in a euro-dollar futures contract. Now let's say over the next day, the 3-month euro-dollar rate decreases by 5 basis points. That means that the futures quote increases by 0.05 multiplied by $25 is a positive payoff of $125 to the long position. That means, again, the exchange now deducts $125 from a short position in the futures contract and deposits $125 on the margin account of that long position. And then between November 3rd and 21st of December, there might be many changes on a daily basis. Let's suppose at the very end, the 3-month euro-dollar rate decreased from 2.5% to 2.25%. So the decrease overall is 25 basis points. In other words, the futures quote increased from 97.5 to 97.75. And multiplying these 25 basis points by $25, that yields that cumulative payoff to the long position of $625. So now, once you reach December 21st and you have your $1 million available, you can invest them at the current 3-month euro-dollar rate of 2.25%. And that means until March 21st, over these next 3 months, that would earn interest of $5,625. Notice the formula to calculate this is $1 million times 1 plus the 2.25% interest rate divided by 4 because it is quarterly compounded by definition of the 3-month euro-dollar contract to the power of 4 times 3 months. And then I subtract the initial $1 million investment to get just the interest which I earn. Notice on December 21st, I also have $625 which was my payoff from the long position in the Eurodollar futures contract. So this was this cumulative payoff of the $625 over here, because there was a decrease of 25 basis points in the 3-month Eurodollar rate. And this $625 I can also invest at the 2.25% interest for the next 3 months. And that yields on March 21st, $628.52. So now taking this together, the $5,625 plus this $628.52 on March 21st, and computing what percentage this is out of the $1 million investment on December 21st, that gives me 0.625%. And if I multiply that by 4, that gives me an annualized interest rate of 2.5% in quarterly compounding, which I have earned between December 21st and March 21st. And notice this is exactly the interest rate which I tried to lock in back on November 1st. Indeed, with that long position in the Eurodollar futures contract, where the quoted futures price was 97.5, that corresponded to that 2.5% interest. Notice that Eurodollar futures contracts are quite similar to forward rate agreements, which we have seen in Chapter 2. Both of them help us to lock in interest rate at which we can either lend or borrow at a future point in time. The forward rate agreements are a little bit more flexible because you can choose exactly starting at what point in time until what other point in time in the future you want to lend or borrow money at that fixed forward rate. For the futures contract, of course, you can only lock in rates for contracts which are actually traded on the exchange. So the exchange tells you what are the maturities of all these different futures contracts, and all these futures are written for an investment for 3 months. Notice that there are a few more differences between forward rate agreements and Eurodollar futures. First of all, forward rate agreements we have mentioned in Chapter 2, they are all traded over the counter, while now the Eurodollar futures are traded on an exchange. And so you have differences in regulatory requirements and some other differences which we have talked about in Chapter 3 and 4. But then even more important is that Eurodollar futures are settled daily as any other futures contracts, while forward rate agreements are settled only at the maturity date. Now, because there is a very strong correlation between Eurodollar futures and the risk-free rate, which is used for discounting, and this correlation will then imply that the futures rate is going to be higher than the forward rate. And in particular, the difference between the futures rate and the forward rate can be quantified by the volatility in the interest rate captured by that sigma squared times these dates to maturity, where again we have here that timeline where you started at time small t and you lock in the rate between t1 and t2. So all this formula is saying that the futures rate will be higher than the forward rate, and the difference can be quantified by how volatile these interest rates are, and therefore how important this daily settlement is. As already discussed in Chapter 2, we can do again duration-based hedging. And the idea was that, at least to a first order approximation, the duration captures the volatility of bond prices. And therefore, if we match the duration of assets and liabilities to which we have exposure to, then changes in assets and liabilities due to changes in interest rates will exactly offset each other. As we have mentioned in Lecture 2, duration-based hedges only protects us against small changes in interest rates and only if there are parallel shifts in the yield curve. The parallel shifts, the importance was that both interest rates with short horizons and interest rates with longer horizons change exactly by the same amount. If they don't change by the same amount, then duration by itself will not be a sufficient measure. The assumption of small changes is about the fact that the duration is the first order approximation of the bond price change. And therefore, if the interest rate change was very big, then we would have to consider higher order approximations, so taking into account, for example, bond convexity. So if you think about duration-based hedging using futures, if you have a certain portfolio for which we try to hedge changes in the yield delta y, then the change in our portfolio value can be written as minus the portfolio value where you start out with times the duration of that portfolio times that change in the yield. Moreover, the contract price of an interest rate futures changes by delta F, where this is given by minus the value of the futures contract today times the duration of that futures contract times the change in the yield. And so if you short sell n number of futures, then the overall change will be the change in your portfolio minus n times the change per futures contract. And if you factor out delta y, which shows out in both of these terms, then you can rewrite this as minus the price of the portfolio times the duration of the portfolio minus the number of futures contract times the value of one futures times the duration of the futures. And so this tells us now that the number of futures should be exactly equal to this thing divided by this term over here. And that's what I write over here on slide 26. Let's look at an example. Let's suppose you hold a portfolio of government bonds, which is worth $10 million. We are concerned about volatility and interest rates. In particular, if interest rates increase, then the value of our bonds may drop. And let's suppose we want to hedge the risk over the next 3 months in interest rates, and we have a 3-month Treasury bond futures contract available. And that Treasury bond futures quote is 93-02, which means that $93 plus 2 divided by 32, and that's per $100 face value. Now each Treasury bond futures is written on $100,000 face value, so that means that that futures contract value is $93,062.50. Let's suppose our government bond portfolio has a duration of 6.8 years in 3 months, so at that maturity date of the futures contract. And let's suppose that that Treasury bond, which will be delivered in the Treasury bond futures contract, is a 20-year bond with 12% coupon and a yield of 8.8%, and the duration of that bond in 3 months will be 9.2 years. So then what is this optimal hedge? You're going to take short positions in the Treasury bond futures, because this will basically help you to lock in the price at which you can buy Treasury bonds. Or in other words, if the interest rate increases and your bond portfolio drops in value, then as a short position in the Treasury bond futures contract, you get a positive payoff, as the underlying which you have to deliver will be worth less compared to the futures price. And then how many number of contracts do you want to short sell? Well, it's gonna be the value of the bond portfolio which you try to hedge divided by the value per futures contract times that ratio between the durations of the bond portfolio which you try to hedge and the bond which is underlying that futures contract. And that gives you here in this example 79.42 short positions in that Treasury bond futures contract. So we have already mentioned that in chapter 2, but the idea is if you have non-parallel shifts in the yield curve, so let's suppose the yield curve is this today, and you might be afraid that the yield curve may increase to this red amount over here, where at the shorter end, the changes in spot rates is much bigger than at the longer end. Then I cannot do a duration-based hedge, because if I would hedge, for example, bonds with a shorter maturity with bonds to a longer maturity, then these changes in the yields of these bonds are very different, and I cannot factor them out in my duration-based hedge. But what we can do is we can subdivide our term structure in different buckets. And what we assume is that within each bucket, that change in the yield curve is almost parallel. And similar in that second bucket, these changes in spot rates at the shorter and longer end are quite similar, and similar in all these different buckets, although the short rate changes in that final bucket might be much smaller than in that first bucket. But again, within the first bucket, these changes are quite similar, and within the last bucket, these changes are also quite similar. So if you assume that within a bucket, there is still approximately a parallel shift, then what we can do is just a duration-based hedge within each bucket. So you would lump together all assets and liabilities with maturities within one of these buckets and then construct a duration-based hedge. Of course, this only works if you have quite a lot of different assets and liabilities at various different maturities. But especially for financial institutions, that's usually the case. They enter a lot of different positions, both in bond markets directly, as well as other loans which they have in their portfolios, and also interest rate derivatives. A final issue is liquidity risk, and this is related to our case studies on long-term capital management and also Metallgesellschaft. So liquidity risks is if someone has actually some value on a balance sheet, but that firm needs in the short term some cash, and it might be that they just don't have enough cash to access in the short run, so they cannot roll over, for example, short-term borrowing, even though it would hedge long-term investments. And this kind of liquidity risk is not accounted for with a duration-based hedge. So finally, I want to look at swap contracts. Swaps are agreements between two counterparties to exchange cash flows at several points in time until to the maturity date of the swap contract. Let's consider an interest rate swap where one party, let's call it party A, agrees to pay party B a fixed interest rate on a certain notional principal amount, and on the other side, party B agrees to pay party A floating interest rate. So floating interest rate means just whatever the current interest rate is in the market. So we also call A the fixed rate payer and floating rate receiver, and B would be the fixed rate receiver and floating rate payer. Notice that the two parties only exchange the interest rate payments based on the principal, but they never actually have to exchange the principal by itself. There are two ways to value swap positions. The first method would just be an exchange between two bonds. One is paying a fixed coupon rate while the other pays a floating coupon rate. And the second method bases on forward rate agreements. So you can think of a swap where you have exchanges of fixed versus floating rate at many points in time as a combination of multiple forward rate agreements. Let me give you a more specific example. Let's have the two counterparties, Intel and Microsoft. And let's suppose that in January 2012, they enter a contract where Microsoft promised to pay every 6 months 5% interest on $100 million, while Intel promised to always pay the current 6-month LIBOR rate to Microsoft on this $100 million. And the maturity date of this swap contract is in 3 years. So this means that there are 6 payments between Intel and Microsoft. Microsoft always pays 5% of 100 million, which is 5 million per year or 2.5 million per 6 months, while Intel just pays whatever the 6-month LIBOR is on that $100 million. Notice that the easiest way to do this is with cash settlement. So that means if the LIBOR rate is higher than 5%, then Intel would just pay the difference between the LIBOR rate and the 5% based on this 100 million to Microsoft. And if the LIBOR rate is less than 5%, then Microsoft just pays the difference between the 5% and the LIBOR based on the 100 million to Intel. So let's take an example. Let's suppose on January 5th, 2012, 6-month LIBOR was 4.5%. That's when they enter the contract. That means the floating rate cash flow from Intel to Microsoft will be the 4.5% on 100 million. That's 4.5 million divided by 2 because the payment is made twice a year. So that means they have to pay 2.25 million. And on the other side, Microsoft has to pay to Intel 2.5 million. That's this 5% interest per year on the 100 million, and again paid every half a year. So that means the cash flow to Microsoft is what they receive from Intel minus what they have to pay, and at that first exchange, they will have to pay $250,000 to Intel. Now let's suppose on July 5th, 2012, the LIBOR drops to 4.2%. That means after 6 months, Microsoft receives from Intel 4.2% annualized on the 100 million, or that's for this half year, the $2.5 million. And on the other side, Microsoft has to pay again that fixed interest of 5% on the 100 million for the half a year. That means $2.5 million. Again, Microsoft has to make a payment of $400,000 to Intel. Then let's suppose that on January 5th, 2013, the LIBOR rate is 4.8%. That means 6 months later, Microsoft receives 2.4 million, still has to pay the fixed payment of 2.5 million. That means they lose again 100,000. On July 5th, the LIBOR, let's suppose, is 5%. And that means 6 months later, the payments which Microsoft receives and has to pay are exactly offsetting, and there's a zero cash flow. And then let's suppose on January 5th, 2014, the realized LIBOR rate is 5.5%. That means now 6 months later, Microsoft gets $2.75 million, while they only have to pay $2.5 million. Now finally, they get a positive cash flow of $250,000. And then on July 5th, 2014, we have a realization of 6.1% LIBOR. That means now at the maturity date of January 5th, 2015, Microsoft will receive $3.05 million, while they have to pay again the fixed amount of $2.5 million. And so the cash settlement means that Intel pays Microsoft $550,000. Of course, the cash flows to Intel are exactly opposite of what they are for Microsoft. So there is a zero-sum game in this swap contract. Swap contracts can be used to either convert a liability or an asset. So let's suppose in the case of a liability, Microsoft has to pay to a bank on a certain loan the LIBOR rate plus 0.1%. Now, if Microsoft enters the swap with Intel, that means they pay 5% fixed and get the LIBOR rate. And that means if the principal is exactly the amount which the loan is, which Microsoft has from that bank, now they convert that liability of paying LIBOR plus 0.1% into a fixed interest rate of 5.1%. So how do I get this? I have to pay LIBOR plus 0.1% plus 5% minus LIBOR. So this adds up to 5.1% fixed. On the other side, let's suppose Intel was borrowing $100 million from a bank at 5.2% fixed rate. Now, if they enter the swap contract, they would pay LIBOR on the $100 million to Microsoft. They get 5% interest. So overall, that converts the liability of Intel to LIBOR plus 0.2%. Now, in reality, things are a little bit more complicated. Typically, Intel and Microsoft wouldn't find each other by themselves. And so instead, they would approach a financial intermediary who would be willing to trade both with Microsoft and Intel. But now that financial intermediary may charge Intel a slightly higher fixed interest rate than 5%, so let's say 5.015%, and then to Intel they give a slightly lower fixed interest rate of 4.985%. So why do Intel and Microsoft want to do that? Well, for them it is arguably difficult to find counterparties, so they don't know who else would actually want to take an offsetting position. But this financial intermediary is always there to trade with them, so it is just much easier. They don't have any search costs, and they can immediately trade when they want. On the other side, if the financial intermediary, let's say, starts trading with Intel, but Microsoft is not yet ready, then the financial intermediary actually takes some risk until they can enter the offsetting position with Microsoft. However, once the financial intermediary enters both positions with Microsoft and Intel, now they get actually a certain profit of exactly the difference between these fixed rates, which is 3 basis points. Okay, why is that? Well, because the LIBOR which they receive from Intel, they just pass on to Microsoft. And again, the fixed rate which they pay to Intel is offset by the fixed rate from Microsoft, plus they can keep a small percentage on that $100 million. Swap markets are quite liquid, so financial intermediaries are always ready to trade with counterparties, and a lot of counterparties actually want to enter these kind of contracts. And therefore, the spread which a financial intermediary can charge is usually quite small. so typically of an order of about a handful of basis points. Besides the risk that the financial intermediary may enter a contract with Intel before Microsoft is ready, so besides that risk of having temporary exposure to risk, there's also the reason that the financial intermediary may have less bankruptcy risk than either Intel or Microsoft, and therefore if Intel and Microsoft trade with the financial intermediary, they have to be less worried about their swap counterparty defaulting, and so they are willing to actually pay a little bit of premium to that financial intermediary, and on the other side, the financial intermediary bears counterparty risk against Microsoft and Intel. Now, this argument, of course, only holds if the financial intermediary is actually safer than Intel and Microsoft. Otherwise, Intel and Microsoft actually would be better off trading with each other, as then the default risk might be lower. Converting an asset is very similar to converting a liability. Here we just assume that Intel actually had an income which is in LIBOR minus, let's say, 0.2%. But they actually would like to earn a fixed interest rate. So that, again, through the swap where they pay LIBOR to Microsoft and get fixed 5% interest, now they can convert their income of LIBOR minus 0.2% into a fixed earning of 4.8% interest. Similarly, suppose Microsoft had some income on an investment of 4.7% fixed. If they rather would earn LIBOR, then they can again, through the swap contract, exchange that into an income of LIBOR minus 0.3%. And again, if Intel and Microsoft don't trade to each other directly, either because they're worried about counterparty risk or because there are surge costs and Intel wouldn't know that Microsoft actually would like to enter the offsetting position, but Intel knows the financial intermediary is always available for trading, then if you have that financial intermediary in the middle, again, they would charge a spread between what they give to Intel versus what they get from Microsoft so that they get some profit of a few basis points. And Intel and Microsoft have now slightly worse conditions than if they trade directly with each other. So the next question is, why do Microsoft and Intel actually want to use this swap contract? So let's think again about the liability. If Intel actually prefers to pay LIBOR plus 0.2% instead of the fixed 5.2%, and Microsoft prefers to pay a fixed interest rate of 5.1% instead of LIBOR plus 0.1%. So why doesn't Intel directly enter with a bank a contract where they borrow at a floating rate, and why doesn't Microsoft directly enter a contract where they borrow at a fixed rate? One explanation might be that there is a comparative advantage. Let's suppose that if Microsoft borrowed fixed from a bank, then the bank would charge an interest of 1.15%. But if they borrow floating, then as in the previous example, they could pay LIBOR plus 0.1%. On the other side, let's assume that Intel can borrow fixed at 5.2% and they can borrow floating at LIBOR plus 0.3%. Now we see from this example that Microsoft can always borrow cheaper than Intel, either at fixed or floating, but Intel has a comparative advantage to borrow at the fixed rate, since the difference between floating borrowing is bigger than between fixed borrowing. So if now Intel has a preference to borrow at a floating rate, and if Intel wouldn't use the swap contract, then they would have to pay LIBOR plus 0.3%. And on the other side, if Microsoft prefers to borrow at the fixed rate and doesn't use the swap contract, then Microsoft has to pay 5.15%. And the aggregate borrowing cost would be just the sum of the two, which is LIBOR plus 5.45%. But if you look at the aggregate cost, if Microsoft borrows floating and Intel borrows fixed, then the aggregate cost would only be LIBOR plus 5.3%, so which is slightly less. Let's suppose Microsoft borrows floating at LIBOR plus 0.1% and uses the swap contract to convert that into a fixed interest payment of 5.1%. Then this is actually better than the fixed rate which they have directly from borrowing from the bank. And similar for Intel, if they now borrow at the fixed rate of 5.2% and use the swap contract with Microsoft, then eventually they end up paying LIBOR plus 0.2%, which again is better than if they directly borrow from the bank at the floating rate of LIBOR plus 0.3%. So both for Microsoft and Intel, they can actually borrow now at their preferred terms. So Microsoft borrows fixed, Intel borrows floating. But for both of them, the borrowing cost has been decreased compared to if they directly borrow from the bank. And this is just because Intel had that comparative advantage at borrowing fixed, while Microsoft had that comparative advantage of borrowing floating. This argument is very nice because it bases on the principles of gains of trade from economics, but we have to be a little bit careful. One reason is that fixed rates actually reflect what we expect to happen to the credit rating between Microsoft and Intel. Notice that the relatively low fixed rate of Intel compared to its floating rate may suggest that the credit rating of Intel actually improves over the next few months or year. And so it could be the case that after a few months, Intel might be able to borrow at LIBOR plus 0.12%, and suggesting that if we borrow fixed over a longer horizon, then that fixed rate is comparatively low. But then if this is the case, then it may not be good for Intel anymore to lock in that LIBOR plus 0.2% through the swap contract, because if they would just wait a little bit longer, maybe they better just borrow right now at the LIBOR plus 0.3%, but as soon as the credit rating improves, they replace their debt by a new contract where they borrow at LIBOR of 0.12%. And then this position in the swap contract and borrowing fixed may not be preferable anymore for Intel. Next, let's look at what is the credit rating of a swap rate for, let's say, n-year time horizon. And let's consider a swap where you exchange 6-month LIBOR for that fixed swap rate. To illustrate that, I want to move to the virtual whiteboard. Let's suppose we set n equal to 10 years, and party A wants to lend $100 million. And if they lend it always at 6-month LIBOR rates to a bank, then the bank promises to return this $100 million plus the 6-month LIBOR interest rate after 6 months. And that means A bears the credit risk of lending for 6 months to a large bank. But of course, if A does this for 10 years, then there is some uncertainty what the LIBOR rate will be in the future, and there is some uncertainty of what interest payments A receives. If A now also enters into a swap contract where A pays the 6-month LIBOR and receives the fixed swap rate from the counterparty C, and if the swap contract lasts for 10 years, then now A effectively converts all these interest payments which it receives from the 6-month lending from banks into a fixed rate for the 10 years. Now, the credit risk on the 100 million is still just reflects the default risk of a bank for a 6-month horizon, but not for a 10-year horizon. So therefore, we have much lower probability that that bank will default within the 6 months than if we would lend for 10 years. However, we still earn a fixed interest rate. Now, of course, there is still some risk that counterparty C defaults over here, but the default of C during this 10-year time horizon would have a much smaller impact on A, because they would never lose the entire $100 million, but they would at maximum lose an exchange of a 6-month LIBOR to the fixed swap rate. And as soon as C defaults, A can actually enter into another swap contract. So the default risk is relatively small. Therefore, we say that if you sign an N, or in this case, 10-year swap contract, where you exchange 6-month LIBORs for a 10-year swap rate, then the credit risk of that 10-year swap rate still reflects only the default risk of a bank for 6-month time horizon, instead of the default risk of lending money to someone for 10 years. And if we would actually push that to a more extreme example of the overnight index swap rate, where you exchange overnight interest rates into a fixed swap rate, then lending always just overnight basically doesn't bear any credit risk, because you can always lend to someone who you know for sure will not default over the next day. And then converting that into the fixed swap rate, that basically means that fixed swap rate in an overnight indexed contract will give you a truly risk-free interest rate for that time horizon for that swap contract. So we will talk about two different ways to find the value of a swap position. The first one is based on exchanging a fixed rate paying bond versus a floating rate paying bond. Let's denote the value of the fixed rate paying bond by B as fixed, where S is the time when we want to value the swap contract position. And the floating rate paying bond we denote by BFL for floating, also at time S. Now the value of the swap position will be just the difference between the value of these two bonds. In particular, if you are the fixed rate receiver and the floating rate payer, then your value is going to be the value of the fixed rate bond minus the value of the floating rate bond. And if you're the fixed rate payer and floating rate receiver, then it's going to be the value of the floating rate paying bond minus the value of the fixed rate paying bond. Notice that at the initial date where you enter a swap contract, you want to choose the swap rate such that the value of the fixed rate paying bond is exactly equal to the value of the floating rate paying bond, or in other words, the floating rate payer and the fixed rate payer have a current value of exactly 0. So that means at that initial date, you choose the swap rate so that these two counterparties don't have any present value in these positions, and therefore also don't have to pay each other anything to enter these contracts. On slide 43, I provide the general formulas of how you derived the value of the fixed rate bond. And this is just how we value a bond all the time. You figure out what are your coupon payments, which depend on that swap or fixed rate in the contract. One more important convention is that the swap rate is typically chosen such that it is exactly compounded once between payments. So that means if payments are done every 6 months, then you would want to choose the swap rate to be twice compounded per year. If you have monthly payments, then you would choose a monthly compounding for the swap rate. Now, what is the value of the fixed rate bond? That's just the present value of all the cash flows. The cash flows are going to be determined by the fixed swap rate divided by the compounding frequency, because this is again an annualized term, times the principal, which is underlying that swap contracts. So these are the coupon payments which that fixed rate bond is giving you. You discount that by the corresponding spot rates between time S, when you actually want to value your swap position, and time SI, where SI are all these dates between where you are right now and the maturity date of the swap. So SI are these dates where floating for fixed rate payments are exchanged. And then finally, at the maturity date, you receive that principal amount and you discount that again just by the spot rate between time S and time capital T for the number of years between time S and time capital T. So this is just how we always value a coupon bond, where the coupon rate is just determined by the fixed swap rate. On the other hand, the floating rate bond, here we notice that after a floating rate payment is made, then a floating rate bond by definition trades at par. So meaning that its value is just equal to the face value. And therefore, any time right before the next floating rate payment is made, the floating rate bond would be equal to the principal plus that floating rate interest payment, which we will receive in the next instant in time. And therefore, we can write down the value of the floating rate bond at time S between two payment dates at SI minus 1 and at time SI equals to what will the floating rate bond be worth at time SI when the next floating rate payment is made, which depends on the floating rate realized at time S minus 1. And we just take that value and just discount it by the risk-free rate back to time S. The second method will be based on forward rate agreements. And here we realize that for a swap contract where you exchange fixed for floating rates at many points in time, these are really just a combination of several forward rate agreements. So remember, a forward rate agreement is also just an exchange between a floating and a fixed rate. So therefore, the swap contract is going to be the sum over all the payoffs of forward rate agreements and discounted back to time S. Notice this formula looks quite complicated. It's just because these notations are kind of tedious, but I think it will be much more clear when we get to a numerical example. So let's look at an example of a bank which pays the 6-month LIBOR and receives a fixed swap rate of 4.5% every 6 months, and the principal is $100 million. Let's suppose that the swap was entered a while ago, but now it has 1 year and 4 months left to maturity. And let's suppose the 4, 10, and 16-month spot rate are 4%, 5.5%, and 6% continuously compounded. And let's suppose that the 6-month LIBOR rate semi-annually compounded 2 months ago. So when the last fixed for floating rate payment was made between the bank and its counterparty was 4.2%. So what is the timeline here? So in 4 months, we have the next exchange of fixed for floating payments. At that date, the floating payment will depend on the 4.2% semi-annually compounded LIBOR rate, which realized 2 months earlier, and that determines my value of that floating rate bond. So it's going to be just the principal of 100 million plus the 4.2% interest on that 100 million semi-annually compounded. So 100 million times 4.2% divided by 2, that's 2.1 million. So the value of that floating rate paying bond in 4 months will be $102.1 million. Then for the fixed rate bond, we have 4.5% swap rate. So this determines that coupon rate of that fixed rate bond. So 4.5% of 100 million is 4.5 million. Now payments are every half a year. So that means 4.5 million divided by 2 is 2.25 million every year. So for the fixed rate payment bonds, we have the next payment in 4 months, then one in 10 months, and the final payment in 16 months. So we have these coupons of $2.25 million in 4, 10, and 16 months. And at the final date, we also have the principal of $100 million. Now we have to discount that by our 4, 10, and 16 month spot rates, 4, 5.5, and 6%. And this gives me these discount factors. So the first one would be e to the power of minus 4% times 4 months. The second value over here corresponds to e to the power of minus 5.5% times 10 months. And the last value over here is e to the power of minus 6% times 16 months. And so the present value of these cash flows over here can be calculated just by multiplying accordingly by these discount factors. That gives us these values over here, summing it up. That's the present value at the current date of that fixed rate paying bond of 98.76 million. On the other hand, I would just multiply the value of the floating rate paying bond in 4 months by this discount factor over here. That gives me a present value of $100.75 million of that floating rate paying bond. And therefore, the value of the bank as a floating rate payer and fixed rate receiver is going to be just the difference between the $98.76 million and the $100.75 million. And that means that value of that swap position is minus $1.99 million. Finally, let's look at the approach using forward rate agreements. So here we already know that the floating rate payment in 4 months depends on that 4.2% 6-month LIBOR, which was realized 2 months ago. But now we also need to figure out what are going to be the payments in 10 months and in 16 months. And these payments will depend on the LIBOR realizations in 4 months and in 10 months, but of course we do not know what these 6 months LIBORs are. So instead what we do is we figure out what type of forward rates can we lock in for a 6 months investment, starting in 4 months or starting in 10 months. And we take these forward rates as substitutes for these LIBOR realizations in 4, respectively 10 months. So the forward rate in 4 months will depend on the 10 months spot rate and the 4 month spot rate. And we know that formula from chapter 2 that gives us a forward rate of 6.5%. And that will then eventually determine our floating rate payment in the swap in 10 months time. And then similar, we figure out what is the forward rate for the time horizon in 10 months to 16 months. That depends on the 16-month spot rate and the 10-month spot rate. And that gives us this forward rate of 6.83%. And that will determine the floating rate payment in 10 months. Now notice that for the floating rate payments, we usually use semi-annual compounding, while here we use continuously compounded spot rates to get these continuously compounded forward rates. So the first thing I also want to do is convert these continuously compounded rates into semi-annually compounded rates. And that's what I do down here. So now using these semi-annually compounded interest rates, I can determine what are the payments of the floating rate payer. And that will be $2.1 million in 4 months. So that depends on this 4.2% interest rate, which realized 2 months ago. Then we have $3.31 million floating rate payment. That bases on this 6.61% of forward rate, which you can lock in 4 months. And then the payment in 16 months will be $3.48 million, which bases on the 6.95% semi-annually compounded forward rate, which you can lock in between month 10 and month 16. And so for the fixed rate payments, we still have just the 4.5% of the 100 million divided by 2. These are just these $2.25 million. So then we can compute the net cash flows, which you can lock in, which is in 4 months plus 150,000 for the floating rate payer and fixed rate receiver, and then negative cash flows of 1.06 million and 1.23 million in 10 and 16 months. Then we just discount these values again at the 4 month, 10 month, and 16 month spot rates. That gives us these present values, summing it up for the floating rate payer, fixed rate receiver. We get a value of that swap position of minus $1.99 million, which is exactly the same as what we got when we used the method of fixed versus floating rate paying bonds. I want to make one final note about overnight index swap rates. So as we have talked before about this N equal to 10-year swap contract where you would switch 6-month LIBOR for a 10-year fixed interest rate. Here with the overnight index swap rate, we want to consider daily interest rates. So again, if you are party A, you can lend $100 million to always the healthiest bank in the market on a particular day. And they will pay you back the $100 million plus the daily interest rate. And in the swap, I convert the daily interest rate to a fixed swap rate, let's say over 3 months. The idea is again that if I always just lend on a daily basis to the healthiest bank, then I should know pretty sure that overnight that bank doesn't go bankrupt. And my $100 million over here is protected, so I don't really have credit risk for that. And then the daily interest rates, even though there's uncertainty over the 3 months what these daily interest rates are, I swap them in the swap contract to a fixed interest rate. So in that sense, I earn now a fixed 3-month interest rate on this $100 million. Now, of course, there is over these 3 months a chance that party C from that swap contract may default. But if that party defaults, then there's not that much at stake. It would be just the exchange between the fixed rate and the daily interest rate. And that's just a very tiny percentage, or even just a few basis points of the $100 million. So the default risk over here is very small. If you contrast that again to lending for 3 months to a bank, and the bank repays plus 3-month interest, then this strategy is much more risky, because now if I give for 3 months the 100 million to that bank, if that bank defaults, then I lose my entire $100 million. So the overnight index swap rate, that concentrate in the swap contract, that's really a very good proxy for a 3-month risk-free interest rate. And of course, you can also look at many different maturities. It doesn't necessarily have to be 3 months. You could also look at 6 months or a year or even longer. In this example on slide 49, I actually write a different strategy where you could borrow always on a daily basis $100 million and always pay the daily overnight interest rate, and then use a swap contract to convert that into a fixed interest rate. So in this swap contract, I would receive the daily interest rate and pay the fixed rate. So in that way, I know over the next 3 months exactly how much interest I have to pay. And then I could lend for 3 months to another bank, the $100 million. And typically that 3-month LIBOR is higher than the 3-month swap rate. Now here there is actually some credit risk, right? Because if I lend for 3 months to the bank, therefore this strategy which I describe over here is really a bet on the default risk of that bank over the next 3 months. And if you look at that spread between the LIBOR and the overnight index swap rate, then you see that most of the time that difference is very close to zero, up until to the global financial crisis in mid-2007, when it suddenly started to increase and people started to be worried about default risk of banks, even within a 3-month time horizon. And then this difference actually spiked to about 3.5%. And that's just after Lehman Brothers went bankrupt. And people were really worried that this bankruptcy of Lehman Brothers leads to spillover effects on the entire financial industry, and many banks will go bankrupt within a short time. After that, central banks intervened very fast and injected a lot of money into the banking system and also bailed out a lot of banks. And after that, the spread quickly decreased again, and after the crisis ended up again very close to zero. To wrap up this chapter, I would like to talk a little bit about currency swaps. Currency swaps are very similar to interest rate swaps, except that you involve different currencies. Now, for a currency swap, one party pays in one currency, let's say US dollars, and the other party pays in another currency payments, let's say, for example, British pounds. These payments can either be both at a fixed interest rate or both at a floating interest rate, or it could involve one at the fixed rate and the other at the floating rate. One more difference between currency swaps versus interest rate swaps is that the two parties which enter the currency swap will actually exchange the principals in the different currencies. So let's jump directly into an example. Let's look at an agreement between Apple and BP. Let's suppose Apple pays 3%, 1 times compounding per year, on a principal of 100 million British pounds, and receives 4%, also 1 times compounding per year, on a principal of 150 million US dollars. And let's suppose that the maturity of this swap contract is in 4 years. At the initial date where Apple and BP signed the contract, Apple will have to deliver the principal of 150 million US dollars and receives the other principal of 100 million British pounds. In the subsequent years, Apple then has to pay 3% interest on the 100 million British pounds. That means it has to pay 3 million British pounds in year 1, 2, 3, and 4. And on the other side, Apple receives from BP 4% interest on the 150 million US dollars. That means 6 million US dollars per year in year 1, 2, 3, and 4. And in the final year, at maturity, Apple then also receives again the 150 million US dollars, which it initially gave to BP. And on the other side, it has to return the 100 million pounds to BP. So in that sense, if you look at these contracts, Apple is really just lending 150 million US dollars to BP in year 0 and receives 4% interest for 4 years. And on the other side, Apple receives a loan from BP of 100 million pounds and pays 3% interest on that loan. Why do Apple and BP want to enter this kind of contract? So you can think of both converting a liability or an asset. let's make an example about the liability. Let's suppose that Apple wants to open a new store in the UK, and to open that new store they need British pounds, but they really would prefer to pay in US dollars, and then they would prefer to earn US dollars in the future. The swap contract helps them to achieve this goal. They would actually pay 150 million US dollars, receive the 100 million pounds to open the store, and then over the next 4 years, when they start earning pounds, then they pay back 3 million pounds to BP and earn $6 million until to the maturity date, when Apple has to pay back 103 million pounds to BP and receives the entire payoff of 156 million US dollars. So in that sense, the cash flows here, they receive the pounds which they need initially to open the store, but they have to pay US dollars, which they actually prefer. And then in the subsequent years, the pounds which they earn, they can convert into US dollars so that they get their earnings back in the currency which they desire. And then the last question is, why doesn't Apple just directly go to a UK bank, borrows pounds to open the store, and then pays back these borrowed pounds with interest when they start making money in the UK? One reason could be that BP as a British company has much better terms to borrow UK pounds with the local banks in the UK, while Apple has much better conditions to borrow US dollars in the US. So Apple then would like to actually borrow US dollars, give them these US dollars to BP, while BP gives the British pounds to Apple, and so then Apple can undertake its operations in the UK, and therefore both can borrow at their cheaper rates with the comparative advantage, and so they both are going to end up with better borrowing conditions. So let's try to figure out how to value these positions in a currency swap. Consider again that swap between Apple and BP, and let's suppose at origination at time 0 the exchange rate in the market between US dollar and British pounds is 1.56 US dollar per pound. And let's suppose the short rates in US dollar are 2.5% and the short rates in British pounds are 1.6%, and all short rates independent of the maturities are equal to these rates. So meaning the yield curve is flat. Then what is the value of the swap contract to Apple on the original date at time t0? So we can value that swap in two different ways. On one side, we can say that Apple lends 150 million US dollars to BP and borrows 100 million British pounds from BP. And so we can value these two different bonds, one in US dollar, one in British pounds, and then compare these two values. So how do we do that? In US dollar, we have $6 million payments in year 1, 2, and 3, and $156 million in year 4. In British pounds, you have 3 million British pounds payments in year 1, 2, 3, and 103 million pound payment in year 4. If you discount the US dollars at the 2.5% interest rate, continuous compounding, and the UK pounds you discount at the 1.6% interest rate, continuous compounding, then you can compute the present values of both the US dollar payments, which is 158.28 million US dollars, and the present value of the British pound payments are 105.31 million pounds. Now, what's the value to Apple at time 0? So they received this present value of 158.28 million US dollars. On the other side, they have to pay a present value of 105.31 million British pounds. And remember, 1 pound is worth 1.56 US dollar at this initial date, time t0. And then on the other side, Apple receives 100 million pounds initially, which is worth 1.56 US dollar per pound. And Apple has to deliver 150 million US dollars. So if you add everything up at this origination date, time t0, then this is exactly equal to 0. And this is actually how you want to choose the principal amounts in US dollar and UK pounds, as well as the fixed interest payments in US dollar and pounds, such that at the initial date, both parties actually have a 0 present value. Now we can do also the same thing using forward exchange rate contracts. And here the idea is that we lock in the exchange rate in year 1, 2, 3, and 4. and then compute the payoffs both in US dollar and British pounds. To get the forward exchange rate by the no arbitrage concept, we use the covered interest rate parity. The forward exchange rate is equal to the current spot exchange rate, which in our example is the 1.56 US dollar per pound, then multiplied by e to the power of the US interest rate of 2.5% minus the UK pound interest rate of 1.6% times the time horizon to maturity, so either 1, 2, 3, or 4 years. So if we plug in for these 4 different maturity dates, we get forward exchange rates which you can lock in of 1.57 US dollar per pound, 1.59 US dollar per pound, 1.6 and 1.62 US dollar per pound in these years 1, 2, 3, and 4. Initially, they have to pay 150 million US dollars. They get 100 million pounds. 1 pound at time 0 is worth 1.56 US dollars. So the net cash flow minus 150 plus 100 times 1.56, that's a net cash flow of 6 million US dollars to Apple at the initial date. Then in year 1, they receive 6 million US dollars. They have to pay 3 million pounds. Each pound now can be locked in to be exchanged for 1.57 US dollar per pound. That means now the cash flow is 6 minus 3 times 1.57, and that's a net cash flow of 1.28 million US dollars for Apple. In year 2, you have 6 million US dollars. Apple has to pay 3 million pounds. Now you lock in an exchange rate of 1.59 US dollar per pound. That yields a net cash flow for Apple of plus 1.24 million US dollar. And in year 3, again, they receive $6 million, have to pay 3 million pounds. Now the pound can be exchanged into 1.6 US dollar per pound. So the net cash flow is 1.19 million US dollars for Apple. And on the final date, Apple receives 156 million US dollars and has to pay 103 million pounds. Now the pound can be exchanged for 1.62 US dollars. You have 156 minus 103 times 1.62. That yields a negative cash flow of 10.53 million US dollars for Apple. Now all these net cash flows are in US dollars, so you discount them at the 2% interest rate in the US for 1, 2, 3, or 4 years. These are the present values of these net cash flows. If you add up everything, it gives you a 0 present value. And of course, on the other side, the value of BP is exactly the negative of the value of Apple, and which is 0 as well. Now let's go to the second part of this question. Let's say after 2.5 years. So you still have 1.5 years left in that swap contract. The current exchange rate is 1.3 US dollar per pound. So meaning that the pound depreciates against the dollars. And now the question is, what is now the value for Apple of this currency swap? So if you use again the principle of exchanging bonds, in this question we still assume that the spot rates are 2.5% in US dollar and 1.6% in British pounds. So for Apple, they will receive after half a year, so in year 3, 6 million US dollars, and after 1.5 years they receive 156 million US dollars. And on the other side, Apple has to pay 3 million pounds after half a year and 103 million pounds after 1.5 years. So again, you can compute the value of each of these bonds, the US dollar bond and the British pound bond. The concept is as before, you discount the 6 million US dollars by 2.5% for half a year, plus the 156 million US dollars discounted for 1.5 years at 2.5% interest, and that's exactly equal to this amount. Notice here I write it a little bit different. I just add up these two present values at time 0, and then I multiply by what the risk-free rate earns from time 0 to times 2.5 years in the future. And then similar for the UK pounds, I discount the 3 million pounds for half a year by 1.6% and the 103 million pounds for 1.5 years by the 1.6% interest rate, and that yields me this present value in pounds. And now at that current date in 2.5 years, we say the exchange rate is 1.3 US dollar per pound. So the difference in these bond values is the bond value in US dollars minus the bond value in British pounds times that exchange rate. And that gives me now a positive value for Apple of 21.6 million US dollars. Similar, we could use forward exchange rates to value this contract. So now at time 2.5 years, the current spot exchange rate is 1.3 US dollar per pound. We use again the same formula as before to pin down the forward exchange rates in year 3 and 4. So all you have to plug in is the current exchange rate of 1.3 US dollar per pound times e to the power of the 2.5% minus the 1.6% times either half a year to get this forward exchange rate or 1.5 years to get this forward exchange rate down here. Then Apple receives 6 million US dollars in year 3, has to pay 3 million pounds. This pound can be converted into 1.31 US dollar per pound. That means the net cash flow is 2.08 million US dollars. In year 4, Apple receives 156 million US dollar, has to pay 103 million pounds, and these pounds can be converted into 1.32 US dollar per pound. If you add that up, that gives you a net cash flow of plus 20.29 million US dollars. If you discount the 2.08 million US dollars at 2.5% interest rate in US dollars for half a year, you get a present value of 2.06 million US dollars, and discounting the 20.29 million US dollars for 1.5 years at 2.5% interest gives me a present value of 19.55 million US dollars. Adding that up, that gives me the value of the swap position to Apple, which is 21.6 million US dollars. Again, notice that this is exactly the same as the value which we got from exchanging these two different bonds, one in US dollar, one in British pounds. So what is the value of the swap position to BP? It's exactly the opposite, because the swap contract is a zero-sum game, and therefore the cash flows to BP are exactly the opposite in years 3 and 4 than for Apple, and therefore BP has now a liability of 21.6 million US dollars. Therefore, you see we can use exactly the same kind of methods to value the currency swap as we did for the interest rate swap. Either you calculate these values of the bonds in the two different currencies and then just swap, or we use forward exchange rates to lock in the exchange rates in the future, and then we can convert all the payoffs into one currency and then just discount all these cash flows in the same currency to get the value of the swap position. And this concludes chapter 5.